Well, Heather, we're back together again. So always great to be breaking this down with you.
Always fun. It's a highlight of my week for sure, Joe.
Yeah, it's great. We're joined today by Shirley Koss, one of our practice experts here at Woodard, and she's going to be featuring our member of the month. So let's run it down. We have current events. Then we're going to move into our TV and movie quote of the week, where we extract wisdom from the various things we're watching, sometimes from strange places, but we find those nuggets of wisdom. The excellent thing we learned this past week, two truths and a lie, where we're going to try to stump each other, a member spotlight that we just mentioned Shirley will be doing, our Woodard Report article of the week as selected by our senior editor, Heather Satterley, and then we're done. So let's go ahead and get started with current events. Heather, what are you seeing out there?
So I read an article today from Google. So Google did a report on AI usage in the workplace, and what they found was that only 5% of workers are what they call AI-fluent, and only 2 in 5 workers are even casually using AI on the job. So an AI fluent, they've actually defined that as they've redesigned or reorganized significant portions of their work with AI. Now, that being said, I just want to stop and say that there's a lot of jobs out there that right now probably would not rely on AI, especially like frontline workers, may not be using, have the opportunity to use AI. So I just wanted to say that up front is like that's the first thought that came to my mind. So one of the things that they found was that workers who use AI are 4.5 times more likely to report higher wages, which kind of goes along with what, I kind of my interpretation of the article, and 4 times more likely to report a promotion attributed to their ability to use AI, which makes sense. So why are people not using AI? Well, 53% of workers said they didn't think AI had anything to do with their job. It didn't apply. And also that adoption is lagging in small business in rural areas, and obviously with frontline employees, right? So question is, could AI literacy further widen the pay gap that we're seeing between frontline workers and knowledge workers? Kind of, I'm thinking if this is what the data is saying, but who knows? And then the other really interesting thing that they cited in that article was only 14% of workers polled had been offered AI training in the workplace. So that's another thing. So just really interesting. Another cool thing that Google's doing that was cited in the article is Google's launching a new AI professional certificate, and that is going to be offered by companies like Walmart, Colgate Palmolive, and Deloitte. And they're going to start offering that education and the ability to get certified in AI to their employees. So that's exciting news, but I think it's just like a giant underscore of kind of where we are right now. Is that if you're not at least curious about AI, you need to get curious about AI. It's going to be expected, and I think it definitely affirms that those that are really paying attention are the ones that are able to bring more value to the role in their work lives, right? Because it really gives them a little bit of superpowers.
Yes. And what's interesting, in a previous episode, we broke this down where there was a survey done of accounting professionals, and the numbers were drastically different.
They were.
That over 70%, somewhere right in there. I'd have to go back and look at our notes from that episode. Had at least were at least using it as a sort of a super search engine. So I think your thinking on entry level jobs is dead on.
Yeah.
Versus people that are in professional roles already. And maybe it kind of breaks down to there's so much of our role as accounting professionals that is research based. And maybe the more research based your job is, the more likely you are to go put something into a prompt. But I'm really surprised these numbers are this low. I'm not
Yes.
surprised that it's only 14% of workers that say they've been offered formal training, because that's where the real gap is. And we learned that in our Brown course. They weren't boasting on themselves as much as they were just analyzing that they're rare in the space where they were providing meaningful AI training. It's either non-existent or fluffy. And we learned that at our Brown class. I mean, they weren't boasting on themselves. They were just being observant that there's a lack of meaningful, substantive education in the AI segment. And it's a moving target. So
Mm-hmm.
I'd be remiss here if I didn't say, as the host of Scaling New Heights, that we have designed an entire track on artificial intelligence that is substantial. And it's being taught by a variety of experts. But the core piece, a 5-session track that deals with prompting strategies and agent building, is being taught by Randy Johnston, of course, is a leader in tech. And there will be experts in the room directly deployed by Microsoft who are going to answer questions related to the Copilot and the best practices they've seen in general with prompting strategies at Copilot. So if you're looking for meaningful training, technical training, Scaling New Heights is the place to go to get that. And I'm sorry that I went to a commercial there, but it was a lob. I had to swing at it, Heather.
Absolutely.
I
Well,
had
I
to.
mean, we spent a lot of time putting that together, that curriculum together. So I'm
Yes,
really
we did.
excited about it. Soup
Yes,
to
we did.
nuts.
Okay. Okay. So there is what I'm seeing out there is a bit of a pile-on when it comes to month-end automation. Um, month-end automation, Keeper didn't exactly define the category. I think Zenit might have been a little bit of first mover, but they definitely become definitive in the category, and they're called double now. And what you saw in that category is you saw the doubles of this world, formerly known as Keeper, reach into practice management because it was just organic. If you're going to do the month end close and you're going to have tasks related to month end close and you have documents related to month end close, then you might as well do tasks and you might as well do documents throughout the entire cycle, right? So you saw them reaching into project management or practice management rather. And then, I kept saying, I'm just waiting. I'm waiting for the moment where the existing practice management tools are going to start reaching toward month-end automation. Either they were going to acquire the month-end automation solutions or they were going to build. It was inevitable. And now we've seen it. Canopy announced just this past week that they have built a bookkeeping module. There's an article on this in the Woodard Report where they have built a bookkeeping module, and that bookkeeping module reads and writes to the general ledger. Multiple general ledgers is the end game here, so that even if your clients are on different GLs, you can use a solution like Canopy to write and read from the books across multiple licenses, multiple entities. Not that it's multi-entity, but you can talk to multiple entities from a single client, multiple files, and multiple kinds of platforms. Say, for example, Xero and QBO. And that's going to greatly simplify the process, not just of doing the work, but of training people to do the work. It'll be interesting to see exactly how far these solutions go. I don't think any of them have aspirations to become a GL. I think that if you're listening to this podcast and you're in leadership in any of these companies, I would tell you not to become, that would be my advice to you. Don't become a GL, but talk to as many GLs as you can. I think we're going to see more and more of this convergence in the space between practice management and month-end close automation.
You know what's really interesting? I love this topic. In 2017, I went back for my master's degree at Northeastern Innovation. You know that, Joe.
Mm-hmm.
And I had to do a capstone. I had to do a couple of projects. But one of the big project that I built, I had to build something, a wireframe and a whole strategic plan for a product. And that's actually what I designed was a month-end close, an automated month-end close. So it's really cool to see, like, it wasn't around when I did that coursework and I did that project, and I could not build it because I'm not a developer, but I had the vision for it, and to see it come to fruition from all these different angles. Intuit was the first one that I saw when they released their books review feature within product. And now we've seen, kind of bigger guns come out with Keeper and Zenit, like you mentioned. And now we're starting to see them inside of the practice management suite. So really cool to see it. And, they've gone a step beyond of what I was kind of imagining, which is really cool.
Mm-hmm. Yeah, it is. And it is organic. It's a fit. It's exactly what should happen.
Yeah.
And I think we're going to start seeing that same convergence take place with the tax return.
Yes.
that you're going to, and we're already starting to see it with the organizers getting pulled into the practice management solutions. So, it's more than just files and file handling and task handling. It's now actual task data, client collaboration, it's all fusing together. Okay, so now it's time to move into the TV and movie quote of the week. All right, Heather, what are you watching out there?
I went retro this week, Joe. I went back to my high school days. For some reason, over the weekend, I got onto a retro kick and I started watching movies from the 80s. And so my quote's actually from The Breakfast Club. And so at the end of the movie, if you've ever, most of us have seen The Breakfast Club. If you haven't, it's iconic. You have to see it. But at the end of the movie, Brian has written a letter to the principal, Vernon, explaining what they have learned. The big question was, who do you think you are? Right. And he writes that iconic letter. And the quote that I have is actually a line from the letter from John Bender's perspective. And John Bender was the punk, right? He was the punk. In that movie. And so he said, you see us as you want to see us, in the simplest terms, in the most convenient definitions. I'm sure you guys remember that quote. And I love this quote. Well, I love this quote because it reminds us we're wired to categorize everything, right? And it helps our brains be super efficient. It helps us to recognize things. It's really us protecting ourselves and trying to understand the world around us. But it also causes us to miscategorize and only scratch the surface of who a person is, of what their role is in life. And we miss out on the beautiful complexity of the individual person by doing that. When we start saying labels, putting labels on people or assuming they're a certain way because of the job that they have or, how they live their life, we actually miss this opportunity to really dig in deep and understand them on a personal level. And so our clients do this about us as accounting professionals, right? We see this in the memes for accounting professionals that we're boring, that we sit around all day, we crunch numbers, and that's, who we are. And it's really up to us to make sure that they know that we're so much more than that. And, the shift from the transactional and the compliance over to the advisory is the perfect time for us to actually be doing that. And so I really, I got a little philosophical, which, Joe, I tend to do. But I just loved this quote. And I felt like, knowing all of the people, the individual people within our community, I think it's really important for us to hear that and to remember
It is.
that.
And you know what, Heather? It's not just that other people will do that to us. We do it to ourselves.
Absolutely.
Yes.
100%.
So any time that you have a thought and you could, in your thinking paradigm, add the word just in front of it, then second guess that thought. You're not just a bookkeeper. You're not just a tax preparer. You're not just an accountant. Think bigger, think broader,
Mm-hmm.
and then realize you can do things that even you don't know you can do yet. Right.
That's right.
So
Love that.
that's great. I love that. It makes me want to go back and watch it. And the Michael Anthony Hall, the little geeky one, that was Brian.
Mm-hmm.
Okay, that was me in high school. So I have watched that movie over and over and over again because I so relate to that character. And if that helps people go, oh, now it makes sense. I just maybe overshared. Okay.
I'll let people guess which one I was.
So
We'll leave it.
I think you were the what was yes
Yeah, you
because
nailed it. That's exactly who I was. She was the
okay.
basket case. I was the basket
Well,
case.
no, I don't think she was a basket case. I
That's
think
what she
she
called
was.
herself, though.
Well, yes, but because that was the whole thing, you had to break the paradigm, right?
Exactly.
Brian wasn't just the
Exactly.
geek, and she wasn't just the emo. It was that she was so much more than that. She was
Right.
artistic. She was poetic. She was deep, complex, and I see all those powerful qualities in you too. That's what drew me to that. And funny that Shirley picked up on the same thing. Yeah. All right, so we could keep going and say which one,
We
Shirley,
could.
but we got to move on. I have my thoughts. So I'm watching right now the Titans series, and there are a couple of them. There's the Rise of Hollywood. I'm watching the Rise of Wall Street, finding it fascinating. It's been my sort of binge watch while I've been on a working vacation here. And there's a quote. Of course, the context is all about the sort of the rise all the way up to the crash, and then what happened with the regulations after the crash, and then the 80s, kind of the surge of the had to re-corral it in and all this. And I'm on the 80s, 1980s right now. The origins were fascinating. But what I'm quoting here is from the narrator of the documentary, not from any one quote from one of the people that was a player. And the narrator says that market collapse and political intervention forces, while there were rivals, they became allies. While they were allies, they became rivals, right? Week by week, it could change depending on the forces of what was happening in Wall Street at the time. Now, this quote, it starts to break down JP Morgan with Goldman Sachs, and these are the people, not the firms, right? They're actually dealing with JP Morgan Chase. They're dealing with Goldman. They're dealing with Samuel Sachs. These people were allied one minute. They were going at each other the next. And so what does that have to do with us? We are experiencing in accountancy forces that are comparative. They're comparative to what Wall Street was, the forces of Wall Street. Not that I think we're headed into some sort of a technology crash. I'm not saying that, we did have our dot-com bubble burst. What I'm saying is the forces are unpredictable. The forces are disruptive. They could be positively disrupted. I think they will be, but they're disruptive nonetheless. And we're going to start seeing more and more of the rivals of today be the allies of tomorrow. And also what happened underneath the people that were trying to work in this environment are seismic shifts. The ground did move underneath their feet. Merrill of Merrill Lynch was able to see it, pulled out of the stock market 6 months before the crash. So did Goldman. Others didn't see it. We have to be able to see in this volatile environment where the puck is going. Again, I don't think that we're going to have a technology crash. Don't misunderstand me here, listeners. What I'm saying is a software of today could be non-existent tomorrow. A startup of today could end up owning market forces beyond their expected reach a year from now. Anything could happen in the next 12 to 24 months, especially anything could happen in the next 3 to 5 years. We need to be watching up above the chessboard level. We need to be seeing how the pieces are moving. We need to pay attention, because if you pay attention, you could have an unprecedented windfall. If you don't pay attention, you could be negatively disrupted.
Right. Yeah, it's going to be really, we've said this over and over again, we're in an exciting time, but we do have to be paying attention, because the surprise could definitely be a make or break it surprise. Interesting thing, Joe, I was watching there's an AI summit going on in India right now. As we speak. Well, it's probably over now because of the time difference, but there was a photo that emerged on the interwebs today that showed the CEO of Anthropic and the CEO of OpenAI. Everybody was supposed to join hands on the stage, and they did not. Like, they had their hands in the same kind of place, like next to each other, but they didn't actually hold hands.
Well, whoever tried to orchestrate that was a little naive, I think.
Right. But it was just, it was so funny that it was funny that somebody noted that and threw it out on, in the news. So interesting stuff.
And that's just a couple of examples. You got Gemini and you got Copilot, and these are really, if you think of it, they're technologically speaking, because I know they're already established companies, but these are the JP Morgan Chases and Goldman Sachs, the Goldmans and the Sachses and the Merrills and the Lynches of the Wall Street era, metaphorically speaking, comparatively speaking. Yes. Each one of these AIs is like one of those people that literally reshaped the economy of the world. And it's going to reshape the economy of the world. And no, I don't think they'll ever hold hands. As a matter of fact, I would think technologically, if they ever held hands, we'd be in big trouble. I am reading a book right now called If They Build It, Everyone Dies. It's a fun title. Let me talk about that in a future episode. All right. So what did I learn this week? That there are pricing strategies that are known. I just had not intersected them. I was taught this by Ron Baker this week, Ed Kless. as we were doing a planning call for an upcoming pricing workshop that we're all co-leading. And this is an example of why I wanted to be co-led, because they see things I don't see, and then I'm teaching them things about things I see that they don't. And one of the things that they saw that I didn't is there are three different kinds of pricing models, forces, if you will. They're not even they're more forces of pricing. And if you can relate to or categorize where you are, listeners, in one of these three, then this will be a very helpful segment to you. The first one is what's called skim strategy or skim pricing. And with skim pricing, you are pricing very high, you maximize early profit, and you innovate using those profits. And then over time, you bring the price downward. Now, an example of that would be the iPhone. Comes out very expensive, actually stayed very expensive longer than a skim price would normally do. They sustained it longer than the normal arc. But now you start to see them come down market with lower edge SKUs. Tesla did the same thing. Start really high, had to spend $150,000 on a Tesla. Now all the way down to the Tesla X and the Y, which are much more affordable cars. And then they're going to keep even going lower than that. So start high, go low. That's called skim pricing. Then there's a neutral pricing strategy where you just take what you price, you match it to whatever the market benchmarks, and you don't try to compete on price at all. You compete on service quality, would be your product quality, in our case, service quality. I see most accounting firms doing that. I've been asked for more. Can you give me benchmarks? Can you give me pricing studies? What's everybody else out there charging? So I think the most prominent thinking in the profession is this neutral pricing, even though you didn't necessarily know to call it that. I don't think it's the best option, by the way, necessarily. But I think it's I think some people think neutral's the only way to price, which is to benchmark with my competitors. I'm going to tell you which one I think is best in just a minute. And then there's penetration pricing. With penetration pricing, you go low, intentionally undercut on price. You're going for market share at high levels of volume, even to where you could scorch the earth with this price. Then you start moving your way up, 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 up. Now, a great example of this is Intuit, right? So Intuit comes in with this insanely low price, which I think even they didn't mean to underprice at the level that they did, but they disrupt Peachtree. They disrupt real world accounting. It's cheaper on the shelf than these other products. And then, they start moving the price up, but you can only do that so much when people can hang on a desktop product for 5 or 6 years, convert everything to subscription, just tick it up, tick it up, tick it up, tick it up. So that's called penetration pricing. It starts low, goes high. Skimming, start high, go low, go lower. And neutral is match the market as a strategy. Now, which one do I think would be ideal for most practices? It would be the skim pricing. You build a CAS practice that is your 2.0 model. Leave the 1.0 where it's at. Don't disrupt that unnecessarily. You create value propositions that are extreme, differentiated qualities that are extreme. Remember, the iPhone was not Apple's first product. They had the iPod. You build your iPhone, you build your Macintosh, you build the next generation of whatever it is that you want to offer, and then you skim price that. Go as high as you dare to go, then add a little bit, and wait for the market to respond. Worst thing could happen is nobody buys it. That's a learning. Then you come down until someone does. But that's much better than going too low and somebody buying it and you never really knew where you could have started at. And then you can start building some SKUs underneath your highest Cadillac product. And then those will start to appeal to your existing clients. And then you can start to disrupt from within, bring them over into your new product model. When the Macintosh first came out, it was so insanely priced that no individual in their right mind, unless they were ultra wealthy, could buy it. That's the point. Yeah. All right. What are your thoughts on that, Heather?
So one of my thoughts is that at least a lot of folks that are entering the space start with that low price, right? Because they don't have the confidence to bring the high high value, or they don't have they don't feel it, they don't have the confidence to bring that high value service to their clients yet. So they end up creating this price anchor inadvertently because they start doing things that are, they start offering low level services, and then they kind of grow into those high value services. So what would you recommend as far as if somebody's in that position where they've already done it, they've already anchored themselves, how do they flip that? You talked about
Well,
CAS
they
2.0.
they flip it, Heather, by creating an entirely new product, entirely new CAS offering or tax offering. One of the things we're going to talk about in our workshop with Ron and Ed is you definitely want to do that under a different brand. You may even want to do that under a different corporation. But then that pushes an entire reset button on the equation. You take the clients that are designed for your ideal client profile for this new thing, and it's completely separate from the old thing. And in QuickBooks Desktop, QuickBooks Online, same kind of model, right? Macintosh, Apple too. One's going to replace the other, but they lived in bubbles within those corporations, and then they allowed the new thing, the gravitational force of the new thing, to disrupt the old thing, but only when the time was right, only when the new thing was strong enough to sustain itself. In the meantime, you use the older version as the capital, to get the cash flow, the operating capital you need to build the new. It's Steve Jobs, I believe, invented it. I don't know anybody that did it before he did. I think Brad Smith perfected it at Intuit with QBO and QBD. So we can learn something and many books have been written about Steve Jobs. I think they will be written about Brad Smith. So I would read the ones from Jobs, and specifically those on his internal disruption. I bet that was on Brad's reading list.
So, absolutely. No,
yeah.
And I agree with you. That's exactly how I've always seen it done, is you start a new brand, and in some cases a new company, for sure.
All right. One of our members is actually going through that very process right now. We're guiding them through that. And it's working very well. They're extremely excited. So what's the excellent thing you learned, Heather?
The excellent thing that I learned, and I got really excited actually when I stumbled upon this and learned this, because I thought the exact opposite was true. And I guess it's a little embarrassing, but it is what it is that I read a article from the AICPA that more students are selecting accounting as a major in undergrad, and have been for the last 3 years. So it's actually gone up by 7.3%. And I was really excited because, we talk about the pipeline was diminishing, and I think it did for a long time. But I was really excited to see that those numbers are starting to go back up over the last 3 years. And I think they will continue to go up based on what we're seeing in accounting and the shift from transactional to advisory and more high value services. And with the shift in, colleges and universities really leaning into technology. And what's really exciting is we're working on an article right now on the Intuit education program. And they just did a pilot that now they're rolling out to more colleges and universities, where they're teaching QuickBooks and small business accounting to the accounting students. And so they're actually leaving college with understanding how to use QuickBooks, how to work with a small business, which is something that programs didn't have before. So I think that is really going to help us. So I'm excited for that article. Be looking for that over the next couple of weeks. We've interviewed students, we've interviewed faculty. We're really excited about it. So.
Yeah, and I am seeing that uptick. I'm hoping that they're being prepared for the future of accountancy. I hope that they're learning how to be technicians that do accounting, and it'd be interesting to see if the colleges are adapting to that, or if they're just teaching debits and credits and wishing you well. I don't know the answer, but I'll be very interested to see what you've learned from your research.
Kara actually wrote an article. It came out a couple months ago. I think we published it in December, where we actually did look at AI programs in the business schools in the US. And you can go find that article. It's part of a 3-part series on AI learning. And there are lots and lots of AI/business courses that are starting to pop up all over the country. So I do believe that is exactly where we're going, and I'm
Yeah,
excited
and
about it.
I believe, and it'll be interesting to ask Karis because she's at NYU right now as a freshman. What they're going to ask of her. She's doing marketing and graphic design, but same difference, right? Is everything going to end up essentially being a major in whatever you're doing and a minor in AI? I mean, effectively, whether they call it that or not, I think effectively that's going to be the universities of the future. All right, so fascinating stuff. It's time now for two truths and a lie. All right, Heather, we're going to try to stump each other. I don't think I have yet stumped you. I'm still hopeful for today. You've stumped me a few times. So let's let you go first. What are your two truths and a lie? Let me see if I can pick the lie.
Okay, mine. I'm not sure because you know a lot about this subject about inventory. Um, so because you've done a lot of consulting
So
and
no pressure if I get it
yeah,
wrong. It's okay.
there's pressure. So okay, so but they're really geeky facts. So there's no judgment if you don't get them. So thing one, it's about LIFO, last in first out inventory method. So the first thing is LIFO was introduced into U.S. tax law in 1939. Thing two is the IFRS, which is the International Financial Reporting Standards, permits LIFO valuation if a company's revenue is greater than 5 million. It's thing two. And thing three is during periods of rising prices, LIFO typically results in a higher cost of goods sold than FIFO, which is first in, first out.
Okay, so let's start with number three. That during periods of rising prices, LIFO typically results in higher cost of goods sold than FIFO. Well, yes, if you're paying more for the more recent product, the last thing you put on the shelf, is most recently put on the shelf is going to result in higher costs than the first thing that you put on the shelf because it's older and cheaper. So I can say, okay, that's definitely true. For the other one, it could be on the technicalities of the year, the dollar amounts. It's going to be a lot tougher. And I don't know anything about international financial reporting standards. I do know that at the time I was a warehouse expert, 5 million was not the number, and it was that you were required, not permitted. Since I don't know the exact date that LIFO was introduced into the U.S. tax code, I'm going to have to just guess that thing one is true. The date would be what's wrong. And I'm going to go that thing two is wrong because I think that it's require, not permit. And I don't think the dollar amount's correct.
So you're right. You're absolutely right. Thing two is the lie, and it is because the international financial reporting standards do not permit the use of LIFO at all, no matter what.
Oh, so I got it right for the wrong reason. Okay. So there you go. I'll take it though. Okay. So here are mine, and they're going to be based on the history of Wall Street. Go figure. Okay. So, because I'm watching that right now. So Wall Street's named after a wooden wall that's built by Dutch settlers in the 1600s to protect New Amsterdam. That's number one. Number two, before New York dominated finance, Philadelphia was once the financial capital of the United States. And number three, JP Morgan founded the New York Stock Exchange.
Ooh, I think you may get me on this one. I think number two is right. I think number two is what I'm pretty sure that is correct. Thing one makes sense that it would be a wooden wall, but then it could be a technicality that it wasn't a wooden wall. It could have been a stone wall or some other kind of wall. Or it could have been somebody's name wall, right? Who knows? And then JP Morgan founding the New York Stock Exchange. I don't think that's true. I could be wrong, but I'm thinking that's the lie.
And that is the lie. He was instrumental. He was the largest banker and financier in the world, but he did not found it. Nope. So yeah, you picked the lie, and Wall Street was actually named. Now, not Wall Street, the actual street called Wall Street in New York before it was a center of finance was founded and named after a wooden wall. That's
A
correct,
wooden
because New
wall. Okay.
Amsterdam
That makes
is
sense.
New York. Yeah, so it's a little fun. I thought I was going to throw you on that one because I was talking about the street and not Wall Street. But no, didn't stump you.
Oh.
Okay. All right. So all right. So we have another tie. All
We
right.
had a draw. Yes.
All right. So now it's time for our member spotlight.
Thank you so much, Joe. I am excited to share today a story about one of our members, Dave Eschbach, who owns Clean Slate Financial Services in Richmond, Virginia. Dave has 6 years of experience and just started Clean Slate in the last year. He was a part of the Woodard community before that and knew exactly where to turn when he decided to go out on his own. And his mission is simple. It's basically to enable business owners to thrive by providing on-time, ongoing bookkeeping services. He focuses on recurring services, including bookkeeping, sales tax, reconciliation, QuickBooks consulting, and he loves a good cleanup. He's got about 30 to 35 active clients, and he has them all on flat monthly value pricing. And basically, he feels that the biggest benefit to Woodard membership has been him starting his practice in a completely stress-free environment. He really enjoys participating in our weekly roundtables and the courses, and he also likes to pay it forward by sharing his advice with newer members. In his first year in business, he hit about $360,000 in revenue or gross profit, and he really credits Woodard as well as his faith for making that possible. The 4 biggest shifts that he feels he's experienced since joining Woodard have been his confidence, which we see a lot with our members, his revenue, his systems, getting his processes in place, and his time management. And that's really a pretty small list for someone who's been running their firm for a year. But his philosophy is to charge what you're worth, even if it scares you a little bit. And he also believes in paying it forward and continuing to give generously to those in need. So part of his plan is to build up his revenue so that he can give back to the community. He loves to travel with his family. And so he found a way to kind of combine those two things in procuring a timeshare, but then making it possible for other families to go enjoy that timeshare just as he and his family do. And he volunteers with a firefighter squad. And he's just proof that clarity and community and the right systems from day one can really change and empower you. So I'm so excited to share this member spotlight with you today.
That's awesome.
Love
So
it.
yes, it's amazing to see Dave's journey, and so those pieces where he's giving back to the community do not surprise me at all. I mean, I think that's actually one of the ways he's going to define growth is how can he give more. And so, well, Shirley, thank you so much for sharing that. I was very close to Dave's story, and I think the world of him. I'm so encouraged about the practice that he's built. So now it's time for our Woodard Report article of the week. So Heather, to wrap us up, what did you pick this week?
I actually picked an article that we wrote about Canopy Bookkeeping launching to streamline month-end close. So we wrote an article about that. You mentioned it earlier, but we actually did a nice article on it. And
We didn't orchestrate that, by the way. She had no idea what I was going to pick on my list of what I'm seeing out there, and then she picked this article. So anyway,
yeah,
keep going.
yeah. So it
That's it.
talks about
Okay.
the new month-end close feature. So if you want to learn about what that is and what features are actually getting rolled out, you can check out that article. I also wanted to say it's in beta now. So the full features won't roll out until the summer.
All right. Well, that wraps up our episode. Thank you so much for being with us, Shirley and Heather. I look forward to seeing you next time.